Welcome to Small Cap Nation. I'm Jane King at the New York Stock Exchange, and with me today is Don Steinbruch, a managing partner of Agecroft Partners, a hedge fund third-party marketer. Welcome again, Don. And today we're talking about reinsurance. A complicated subject, but it can be a strategy to enhance a hedge fund portfolio. So first of all, tell me, what is reinsurance?
Well, first of all, it is a very interesting strategy because its performance has nothing to do with the capital markets. And the best way to explain what reinsurance is to use an example. You know, for example, when a bank does a loan to somebody, that bank can keep the loan on their books, or it can sell the loan to someone else who will package it together and sell it to institutional investors. The same thing happens with insurance. When an insurance company sells a policy, they can either keep it on their books or they can sell it to someone else, the someone else being a reinsurance investor. Okay. So reinsurance is an investor that basically buys insurance policies from other insurance companies.
And there are three main categories of reinsurance?
There are. One is life, life insurance. Another is casualty, which is basically lawsuits. And the third, which is what most institutional investors are focusing on right now, is property. So that's insuring houses, buildings against earthquakes, fires, wind, and flood.
Okay. And what are the tax benefits?
So the tax benefits are that if you invest in a reinsurance fund, you don't pay any tax until you withdraw the money. And if you hold the fund for over 12 months, if you're a U.S. investor, it is long-term capital gains.
Okay. And how does a reinsurance fund make money for its investors?
Yeah, so basically the whole concept is that you collect a premium. So let's say that the yield on the portfolio based on premiums is 18%. If there are claims, you're going to pay those claims out. And most reinsurance companies have very sophisticated models that take into consideration every single policy they own. It could be tens of thousands of policies, and they run various scenarios of hurricanes and earthquakes and tornadoes across those portfolios, and they come up with an estimate of what they think the loss is going to be. And let's say the loss is going to be 8%. The difference between those two numbers is the expected return for reinsurance over a long period of time. If claims are higher than that, the returns will be less. And if they're lower than that, the returns will be higher. But over a long period of time, they're pretty accurate in what they think the expected return is going to be.
And then how do they maximize return and also control that risk?
All right, so it's very interesting because they have very elaborate models. And basically they're going to insurance companies around the world that are trying to sell some of the policies they have, and they plug them in, and the firms that have the most sophisticated models are able to price the insurance more accurately. A lot of the models are proprietary. So if you can price it more accurately, you're getting the best value you possibly can for each contract that you purchase. In addition to that, risk control is very important. When there's an earthquake, it doesn't hit the whole world. It hits a city. Or when there's a hurricane, it doesn't hit the whole world. It hits a small geographic area. So what you want to do is, first of all, you want to be diversified by peril, and you also want to be diversified geographically. You want to limit how much you can potentially lose in any one geographical area.
Okay. Now, how does this strategy do compared to stocks and bonds?
Well, the good thing about reinsurance is when the stock market sells off, it doesn't trigger hurricanes or earthquakes. Their performance is generated by nature. Yeah. So in a diversified portfolio, it's going to help reduce the overall risk of the portfolio because the return pattern has nothing to do with the capital markets. And
what's a worst case scenario? Like, when would reinsurance not be something you would want to invest in?
So the worst case scenario is having multiple events in a particular year, like 3 major hurricanes around the world or 3 major earthquakes around the world. And one of the things that you can ask for when you analyze reinsurance funds is they do an analysis on what their expected return is, and they also do an analysis on what they think the return will be in the 1% worst case scenario, or the 1 in 100 bad years, which either is multiple events or a category 5 hurricane that hits Miami, and they should be able to tell you what that calculation is. And I would stay away from firms whose 1% worst case scenario is 35% or lower. So these type of funds tend to generate very consistent returns, but they do have tail risk. Now, 35% decline in a year sounds like it's pretty bad, but if you look at the equity markets, they're going to be down a lot more than one out of every 100 years, mid 30%.
That's true. Okay, so what should someone consider if they're thinking about reinsurance as part of their overall investment portfolio?
Well, I think you want to look at the organization and look at what the bios are, the people that are running the organization. Again, I think from an asset standpoint, you want to invest in a mid-sized firm. I wouldn't go probably below 300 million in assets because you want to make sure they have the appropriate staff to support their operations. You also don't want to go too large either. The way you find inefficiencies in the reinsurance marketplace is by buying policies from smaller regional providers. That's where you generate the strongest returns. If you're a very large reinsurance company, you have to buy contracts from the AIGs of the world, and that's a very difficult place to generate excess return.
Interesting. Okay, thank you very much, Don, and thank you for joining us on Small Cap Nation.